Well, another week and more optimism for global shares, although a very reluctant optimism for the Australian market. So hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 21st of November 2023, and before I get into it, you do need to be aware that what I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. It's been a monumental run for shares in November. Really, shares bottomed out at the end of October, and then we had the Federal Reserve meeting at the start of November, and prices just went absolutely nuts. Prices in the US, the average stock is up over 10%. For our own market, it's been a bit more lackluster. I think we're up about 4% over the same time. It has been pretty sort of incredible. It's been seemingly unstoppable, especially in the US, who's just gone higher and higher and higher. They've had maybe 1 or 2 down days across the month, and it's really just been some incredible movement. But to be honest, it hasn't been too unexpected. And the reason I say that is the negative factor that has caused a lot of selling over the past 18 months has apparently changed over the last month. So with that changing, it's unsurprising that, at least in the US, investors have really jumped back into the market. They've been panicked out by things like, the rising interest rates. They've been panicked out by the rising bond yields. They've been getting great returns on their savings accounts, great returns on interest-bearing debt products and things like that. And that started to turn, and suddenly, I think shares have become more attractive over there. For our own market, the rally has not been as monumental. It's been a bit lackluster, if anything, and it does come after we had the rate rise in Australia at the start of November. So we had the RBA raise rates as opposed to hold rates, which they did in the US. And I think the perspective here is that there could still be more rate rises, whereas the US has rallied on optimism that this is the end of the rate rises. I think the reality is if the US pause and then soon look to cut rates or look to cut rates in the middle of next year, I think it's unlikely our own rates will go much further. It's a bit hard to say exactly what's triggered the inflation around the world over the last sort of 18 months, but it has been a sort of global phenomenon, at least in the Western world. And so, assumedly, if it is resolved in Europe, and we've seen their inflation come down, in the US we've seen their inflation come down, I think there's a fair chance it's resolved here as well, particularly with our Australian dollar strengthening as it has done over the past sort of month or so, and particularly with oil prices coming down again as they have done over the past month or so. The other thing to talk about as well is that in the RBA statements, it's really not discretionary spending that's triggering the inflation. It's things that people have to buy. And it's questionable how much that behavior is going to be affected by changes in interest rates. So we did have the RBA monetary policy meeting minutes. They came out today, and again they talked about things like the inflation in energy prices, electricity prices, essential services, insurance and the like, and mortgages and rents, rental equivalents. And so these are the sort of things that have really been the sticking points for inflation across the past sort of 6 months. The things that higher interest rates haven't really brought down, whereas a lot of the more discretionary categories, goods inflation, for example, has come right back down. And I do want to say it is sort of questionable how much further rate rises will have an effect on these prices without at least crashing the economy. Like if you want to bring these rents down, if you want to bring house prices down, mortgages down, if you want to bring those prices down through interest rate rises, you're going to have to do some economic damage doing so. So I think the RBA, they didn't exactly say that in so many words, but I think they're aware of that. And as a result, I think if there's pauses around the world, if global prices start coming down, I do think our RBA is likely to hold rates. In the US, we are going to see the Federal Reserve meeting minutes for their November meeting. That's going to be tomorrow night. And that was the meeting that really triggered this rally. So this is a pretty important flashpoint. Probably the most important event of this sort of week will be that Fed meeting minutes release. And yeah, I think the risk is that the minutes aren't quite as dovish as everyone interpreted the Fed to be after that meeting, and that does create some risk to the downside. if they are, dovish, and if they are as dovish as everyone expects, really, I think after the run that we've had in US shares, even if they do have more upwards movement, I think the pace of gains is definitely going to slow. So those are pretty much the two major events this week. The RBA minutes for the Australian market, the Federal Reserve minutes for the US market. We'll move on to something a little bit different now. No doubt anyone watching these videos is tired of hearing me talk about bond yields and interest rates and inflation, and that's really, it feels like all we've talked about for the past 18 months. It's been a macro-driven market. It's really been, everything following the leader, following, bond yields or the inverse of bond yields. And as a result, it's been a bit boring, if I'm honest. So we thought we'd talk about a weird of the week, something a bit unique this week. We saw Twiggy Forrest, through his private investment vehicle, buy the hat maker Akubra. So this adds to his clothing collection. He currently also owns R.M. Williams. I guess all he'll need to do is purchase rod and gun, and he'll have the full outfit for any West Australian mining executive. So yeah, that's the weird of this week. And let's move on to the charts now. So this is the US market, the S&P 500, the most broad-based of their indices, and really it's gone from 4,100 up above 4,500 now. They have to be looking around pretty much the peak of this year, around 4,600 index points, and it's not too far away now. It's pretty much 1% away. Definitely achievable on the current move higher. Now, they have had such a strong, incredible move, and like I say, since the November Fed meeting, there's been 2 down days across the whole month. Yeah, so you do have to assume the pace of gains there will start to slow a little bit. So I'd be looking at this 4,600 level, and then if they do see a pullback, 4,520 would be the first target, and then maybe sort of 4,450, somewhere around there. Looking at our own market, we've been a very reluctant move to the upside. We did have the initial spurt higher, and then we did eventually play catch up on the 15th here, but we've sort of stalled out around 7,100 index points. I do think we're a fair chance of breaking through that level, and if we do, we might climb towards 7,200. However, if we pull back, we'd be looking around 7,000 and then 6,950. It is a little disappointing, the movements in our market, given what's happened overseas. It hasn't just been the US. We've seen Japan reach 30-year highs pretty much. It's been strength in parts of Europe. So it is a little disappointing seeing what the Australian market has done, but this is often the way for the Australian market. We need convincing. We need to see confirmation. We might need to see, a bit of a pullback, a little bit of a breather, and then a continue higher in other global markets. We might need to see all of that before our own investors are convinced to put their hard-earned money into the market. And hopefully we do see that across the next few weeks, and that'll mean we might get a bit of a Santa Claus rally as we head into Christmas. So I will wrap it up here for this week, guys. Hopefully you enjoyed. If you did, let us know. If you didn't, keep it to yourself, and we'll see you in the next one.